I assume that means it's okay to call the meeting to order.
Yes.
You have a quorum, right?
Yes, we do have quorum. So let me just, Kim, if you don't mind, just letting the committee members know. So Sarah Sandler is not able to attend to this meeting, so the treasurer has appointed Kim Moss as his other alternate, and she's going to chair the meeting.
Great. So we'll call the meeting to order. And for those of you who don't know me, I'm the Assistant Treasurer for Debt Management in the Office of the State Treasurer. Pinch hitting here for Sarah. So it looks like from the agenda, we have one action item and 3 reports.
So Kim, we have to do a roll call first.
Oh, of course. Do you want to do that?
John?
Yes, of course. Jerry Abrahams,
Here.
Phil DeFranzo,
Here.
Timothy Hodges, Catherine McKinnon,
Here.
Commissioner Perez, Franklin Perry, Chelsea Ross, and Kim Moore.
Here.
Tim Hodges is here as well.
Thank you, Tim. We do have a quorum in attendance for the meeting.
Okay, great. So the first action item is amended resolution authorizing broker-dealer firms for the authority. Is there a presentation?
Yes. So good morning, everyone. So this is a amending and a housekeeping resolution. Back in 2023, the authority determined that it was prudent to maintain a list of qualified broker-dealer firms for certain financial executions, including TBA sales and selling group members, where such lists would be updated from time to time based on the needs of the authority. Last September, the board approved the initial list of firms for TBA sales and selling group members. Since then, 3 firms have approached the authority and relayed their interest in TBA sales and selling group. After reviewing their qualification with the authority's financial advisor, the authority is recommending that the resolution be amended by adding BMO Capital Markets, PNC Capital Markets, and US Bank Corp to the list. I'll be happy to answer any questions regarding the amended resolution.
Are there any questions? Hearing none, may I have a motion to approve the resolution?
I'll make a
move,
motion.
Jerry.
Second, Kathy.
Thank you. It's been moved and seconded. Any further discussion? Okay, hearing none. All those in favor?
Aye. Aye.
Aye.
Any opposed? Any abstentions? Sounds like resolution passed.
Thank you.
Thank you. All right, we'll move on to the first report, 2025 Series A bond issue. Azim?
Yes, so here with me is the head of the housing group from RBC, Corey Hapner. RBC was involved and the lead manager for the 2025A. So he is here happily to provide some color regarding how the sale went and how successful the result was. So Corey.
Good morning. Thank you, Hazim. It's good to be here with you all. So we had a very successful sale for the authority back on the week of January 21st. We were very intentional on the schedule. It was not only Martin Luther King week, but it was inauguration week. And so we moved the authority sale to sort of the middle of the week in order to make sure we had proper investor focus. We ran an institutional IOI, what's called an IOI order period on Tuesday to gauge interest and get an idea as to investors in the taxable market on Tuesday. And then Wednesday that week, we opened up the formal order period for both the tax exempt piece, and then as a follow-on to that IOI period, the formal pricing for the taxable piece. We ended up with over 440 million of orders, a little bit more than 2 times of subscription on the taxable piece, and more than 286 million, almost 3 times over subscription on the tax exempt piece. So a pretty successful sale. We had 35 unique institutional and professional retail accounts participate.
Lorraine, can you move it to the next
sorry.
page? Yeah.
Yeah, right, so we're right here on the highlights. And we ended up lowering yields on the tax exempt term bonds by 5 basis points due to the oversubscription levels there, and then also reduced yields anywhere from 2 to 5 on the taxable maturities. A little bit of a unique approach with respect to the PAC bond on this transaction. PAC bonds are normally priced at a premium. A lot of HFAs use that premium to fund down payment assistance. You pay a higher coupon, obviously, in exchange for that upfront premium, and that has, you know, an impact on your overall structure. The authority wanted to try a par PAC and see if we could draw out additional investor interest rather than the premium PAC, and it actually worked out fairly well. We didn't have as many new investors as we were hoping for in the process, but we ended up nonetheless with a very strong pricing. Lorraine, if you can move forward. There we go. Just in terms of overall market, you can see the market was pretty stable despite, you know, the election inauguration kind of situation, Martin Luther King holiday. So typically what you'll see is, you know, in those holiday weekends, you lose focus on Friday, you lose focus on Monday, and then you hope people come back kind of Tuesday, Wednesday. And, you know, as I just noted in terms of the sale results, that did play itself out. Lorraine, if you could keep moving a couple pages to the comps page right there, over third from the right, you could see these CHFA's term bond pricings on the bottom were amongst the tightest. You can just look sort of right to left. Hazim is always very good at making sure we know that he expects to have the tightest yields in the market when CHFA prices. So that is our job and what we always strive to execute on behalf of CHFA. So you know, it's been a pretty active, fluid market in the housing space. We continue to see a lot of volume, and so the challenges around investor development and investor demand remain there, but we continue to find new outlets for CHFA paper. Next page, Lorraine. This is one more down. This is something that Hazim and the financial advisor have started tracking. Where do deal in and deal out spreads end up for CHFA? So this shows it's a little bit, you know, self-promotion and an RBC commercial, because that brown line and that yellow line are the 2 most recent deals that RBC has executed for CHFA, and the darker blue lines above are the other most recent deals going back to the beginning of last year. So we pride ourselves on being a market maker in this space. We have a 30% share for a reason. Our focus is always how do we expand the investor list, middle markets, you know, tier 1, tier 2, tier 3, retail, obviously, and it is borne out by the tighter spreads there that you see on the tax exempt side. Lorraine, if you'll forward one more page, same goes for the taxable side. So in general, you know, pretty strong pricing for CHFA. Just a couple more comments. Lorraine, a couple pages back, there's a list of investors titled buyer distribution. Keep going. Right there. This is always a nice page because it allows CHFA to see the institutional investors that are participating both on the tax exempt side on this page, and then the page that follows, which is the taxable side. You can see down in the lower left, strong retail, strong both in-state and national retail, coupled with, the net designated institutional business, less retail on taxable, which is of course what you would expect. Strong institutional response there with 34 investors. So with that, I'm happy to wrap it up and turn it over for any questions or comments. It was a strong pricing for CHFA.
I had a question.
Go ahead.
Yes.
When you say strong pricing, I just, not knowing the market like this, is it the quality of the underwriting? Is it like what makes us, on the market look better from a bond perspective? Is it delinquencies? Is it runoff? I'm just curious.
I think it's all above, and it's a great question. We actually did an institutional investor presentation on this deal for CHFA, in part because we wanted to draw out the contrast of the AAA CHFA strong indenture with the replenishment reserve backstop, and we were able to effectively tell that story and pull in the strong investor diversification that you see on a couple of those pages. I think PAC bonds are a component of the structure that CHFA uses. As prepayments slow down, some of the other HFAs have had trouble paying those PAC bonds. CHFA always pays those, according to the table. And so telling that story about the strength of the portfolio, the strength of the management of the authority, all those things play into what we use to try to differentiate your deal in the market versus the others that show up on the comp sheet. The other one that was in the market around the same time is Virginia Housing. They have probably the strongest balance sheet, amongst HFAs in the country. And CHFA priced right on top of them. So I think, yeah, telling the story.
Is there any, we have the unique situation where we have time to own, and we're a Ginny direct seller servicer, so we're constantly talking about paying prepayment speeds. Now, the time to own is a non-subordination second, so if I'm going to have a $25,000 to $50,000 second that I'm not going to be able to prepay, or I'm not going to be able to subordinate, and then it's $2,500 a month. How is that being calculated in our prepayment speeds for, are we getting extra credit for that, or is it just historical? Because I think I look at it like we should be getting in the last 2 years, 80% of our business has been time to own. And those guys, even if rates go down to 5% and I'm at a 6 3/4, I'm not refinancing because I have time to own.
Yeah, I think that speaks to the stability of your program and how we sell it into the market, right? First-time home buyers are generally going to need asset appreciation on the house side or income growth on the wage side in order to be in that position where they're looking to, trade up into a bigger home or a different home. And so we see that often, that the stability and the draw of that prepayment profile plays into the strengths of your credit. Because remember, we're saying
shouldn't that be a story going forward? Like, if you're comparing me to another HFA, my prepayment speeds on those residential mortgages that we've originated in the last 2 years, if rates go down 2%, are going to be dramatically better. And I know,
they're gonna be slower. So that's the way the investors look at it, right? Acceleration risk versus extension risk. That's how, that's how institutional investors look at this. So part of our marketing is exactly that. This is why you want Connecticut HFA paper relative to others. It's because of the deep dive into down payment assistance that you're providing.
Perfect. Okay. Thank you.
Jerry?
Hey, thanks, Azim. Hey, Corey, nice
Yeah,
job
good to see you,
on the.
Jerry.
Nice to see you again. and it sounds like you guys did a real good job in this. I have a generic question, and that so we have I guess AAA ratings, right? And Connecticut is a strong state with a good name in the market. CHFA has historically traded really well, and you guys are helping continue that execution. But can you just tell me, like, from sort of like the Connecticut's of the world to the Virginias of the world, and then to the next tier down in kind of credit quality, what sort of like typical spread differences in yield on the long end? So in other words, not sort of compare us to, like, how do we really compare, not to like the best capitalized folks out there, but what is the pricing advantage that we're getting for our rating versus folks out there who maybe are kind of like in the single A, double A category?
Yeah, it's it's tighter than you would think. I'd categorize it as a 3 to 7, depending on maturity and depending on whether, short, intermediate, or long part of the yield curve. But so 3 to 7, the shorter part of the curve is going to be tighter. The longer part of the curve is going to be a little wider, because that's where you have larger block sizes and you have institutional investors that you need coming in for bigger pieces, and they're going to be much more sensitive to all these sort of credit impacts and all the sort of performance duration impacts that we were just talking about with Phil as it relates to prepayments. So we look at CHFA, and I would say it's amongst the best trading names in the country for a variety of reasons: stability of portfolio, stability of cash flow management, redemption management, down payment assistance reach through time to own, again, as noted. And so, we see that kind of as a 3 to 7 basis point advantage. And frankly, if on the comp sheet that are in the post-sale report here, if you take a chance to look at it, most of the HFAs are high grade AA1 to AAA MBS backed issuers, right? Which is to say that you've got strong collateral, you've got recovery of 99 plus cents on the dollar on defaulted mortgages. So these are all things that play into strength of credit and strength of the name. And that's our job. That's why we did the institutional investor roadshow, to tell that story. CHFA doesn't do that on every deal, because they're a sophisticated, mature issuer that's well received in the market. But every now and again, it's good to remind people of the differentiation of this credit versus others.
Okay, thanks. That's very helpful. Thank you.
Do we have any further comments or questions? Okay, hearing none, we'll move on to financial reports. Allison Murphy.
Good morning.
Morning.
Before you are the January financial reports. On the revenue side, mortgage loan and investment interest revenue are coming in $888,000 over budget for the month and $3.9 million higher than last year. The increase in the authority's investment portfolio is driving the year-over-year variance, as the portfolio is $755 million higher than it was the same time last year. On the expense side, bond interest expense is slightly above budget for the month and $3.4 million higher than last year. Driving the prior year variance is the $635 million increase in outstanding bonds from the same time last year. Servicer fees are $1 million higher than budget for the month and are slightly lower than last January. Bond issuance costs are coming in $751,000 under budget for the month. We closed on our first 2 bond sales of the year this month, and so we expect to recognize the majority of the costs associated with those transactions in February. Administrative expenses are coming in $611,000 below budget and $130,000 lower than last year. When you exclude salaries and benefits for $2.5 million, current year expenses are $70,000 higher than last year. And lastly, the change in net position is above target by $784,000. I'm happy to answer any questions.
Thank you. Any questions? Great. We'll move on to production and delinquency reports. John Chilson.
Good morning. The authority purchased 330 single-family loans in January totaling $93.6 million. That's 42 loans in loan count less than January 2024, but $4.5 million more in dollar value. And that's due to the $44,000 increase in the average loan size over the past year from $240,000 to $280,000. But that $44,000 is also consistent with the increase in the average home prices in Connecticut for 2024. 98.5% of those loans were securitized with 325 loans totaling $92.3 million, and the remaining 5 loans were whole loans. The January MBS portfolio balance ended the month at $3.5 billion. That's $74 million increase over the December balance. The whole loan portfolio through December decreased by 45 loans to $6.3 million or $6.3 billion, ending with a portfolio balance of just under $1.1 billion. The whole loan delinquency rate was for the 6.3%, which was in line with the nationwide average. And the carrying balance for loans and foreclosures increased year over year by $2 million to $13 million, while the number of loans in foreclosure increased by 12. For the month of January, the authority also funded 92 down payment assistance loans totaling $1 million, average loan size $11,200, and 255 time to own forgivable loans at $5.9 million, average loan size $23,300. In our multifamily portfolio, there were no new closings in January, but 2 loans moved to the active status, increasing the loan count to 604 multifamily loans totaling $1.4 billion. There were 7 permanent loan delinquencies, no construction loan delinquencies, and the multifamily overall delinquency rate was less than 0.5%. Any questions?
Any questions for John? Okay, hearing none. Now, the next item is minutes from the January 30th meeting. I assume those need to be passed by a vote.
Yes.
Okay. Do I have a motion to accept the minutes from the January 30th meeting as presented in the package?
So moved.
Thank you. Second?
Second.
Great, thanks. All those in favor?
Aye.
Aye.
Any opposed? And I will abstain as I was not at the meeting. And with that, the minutes from the January 30th meeting are accepted and passed. And I think that is the end of the agenda. Any other business to come before the committee?
Is this just an indication of that you run a meeting, Kim, a little bit quicker than Sarah?
I'll let her know that she takes too much
The
time.
efficiency. Okay.
That could very well be it.
Yeah.
No other business to come before the committee, so can I hear a motion to adjourn?
So moved.
Second?
Second.
All those in favor?
Aye.
Aye.
Aye. Thank you so much.
Thank you.
Meeting adjourned.
You.
Thanks.
Okay.
Bye.
Bye.
The real reason's short, right?
Yeah.
What?